How long do you spend picking out close each morning? Probably longer than most investors spend doing the math for their deal when investing in Des Moines. People tend to choose deals based on intuition, not analytics. Look, you want to know how to leverage your investment properties, but digging into the details might feel like a trip to Jargon Town. Cap rate, NOI, cash-on-cash return, total return. If you feel confused as you start investing, you're not alone. I get a lot of private messages from investors looking to build their portfolio here by investing in Des Moines, often leading to lots of questions. So today, I'm going to help you skip the line and set yourself way ahead of other investors. Let's dive deep into investment analysis, how to do it, and how it can keep you from making a huge mistake. So what exactly is an investment property analysis? It's a key element of any good investment strategy, whether you want to buy office buildings or residential properties as a way to invest in real estate and take advantage of all the benefits. This process helps real estate investors determine our real estate investment's current performance and identify areas for improvement. In its basic form, real estate investing analysis involves calculating your returns. So let's choose an investment property type. Before diving into real estate investing, make sure you understand how to compare markets and investment properties. While you may have only worked with a real estate agent to find a primary residence to live in, you can also work with a real estate agent to help you find good investment properties that meet your needs, whether a residential property or a commercial property. You also have the option to look for a real estate investment property on your own by using online real estate platforms like Zillow. The projections or investment analyses give detailed assessments of how future returns will be impacted by current costs and expenses, taxes, loan values, equity, and other factors that can impact your ROIs. An investment analysis is a better, more precise tool for an investor than simply calculating your cash-on-cash return because it includes the many variables that impact real estate investments. So let's cover a few examples, starting with single-family homes. When looking to find investment properties, you may want to consider single-family homes that can act as a renter's primary residence. Market comps determine the value of these homes, investment or not. These comps, or comparables, are nearby potential properties with similar characteristics. This type of investment property shares variables like the floor plan, number of bedrooms and bathrooms, garage size, and other amenities. This type of investment property generally rises in value if a similar nearby home does. Then there are multi-unit properties. Larger investment properties with 5 or more units are priced and valued differently than single-family properties. The value equates directly to how much income and profit the investment property produces. An apartment building in a neighborhood where house prices are dropping could actually increase in value. You can't just compare your apartment building to others down the street to see how much it's worth. That's why real estate investment analysis is so important. Simple things like washers and dryers in the units could allow you to increase the rents and therefore your total value. There are several primary factors to consider with multifamily properties, but cash flow and appreciation are the two most important variables. Cash flow is simply the money left after all the bills have been paid. And appreciation is the value gained as the investment property value increases. There are not many great ways to estimate future appreciation for commercial properties or residential properties without using a crystal ball. So I personally focus on cash flow. Let's go over the vital elements of a real estate investment analysis. Now, when you know what investment property type that you'll be analyzing, you can move on to the analysis itself. These are the main steps to evaluate a property investment's potential. It combines several real estate evaluation methods to give the most accurate ROI prediction possible. Note the word prediction here. It'll never be 100% accurate. An analysis is just that. It gives you an estimate. If it gives you a potential return numbers, which are not always guaranteed. Remember that buying an investment property comes with risks, whether you only own one investment property or are one of the most successful real estate developers out there buying billion-dollar commercial properties. Let's look at a sample investment property, 1950 Maybury Street. So here are the stats. 8 units, 7 are rented and 1 is vacant and it needs $10,000 in repairs. Purchase price of $400,000. Gross annual rental income of $54,000 with an additional $2,400 from laundry. It has a vacancy rate of 12%. Taxes and insurance are $4,600 per year. Maintenance costs of $3,000. Advertisement costs of $300 to find tenants. Utilities for the common areas cost around $2,000 per year, and it leaves our net operating income at $37,169 per year. Good financial analysis involves inputting key information into a financial model and using its calculations to determine whether the investment is a good or bad deal for you. And you'll need to know these variables for the most thorough financial analysis of residential rental property. Investment property details, number of units, square footage, utility metering design that you'll be using, and market news like new employers coming to town. You'll have purchase information, total purchase expense or your purchase price plus rehab and improvement costs and your closing costs. Then there's your financing details such as the total loan amount, down payment, mortgage interest rates, and closing costs. And there's the fun one, gross income, the monthly rent payments and any other income that the investment property produces. And you have to remember your expenses, maintenance costs, including property taxes, insurance, and repair costs. Now this next part is important. Where do we find the data needed to properly analyze a property? Property details should be available from the seller, but check with your local records office for more comprehensive detailed information. Purchase information includes any upfront maintenance or improvements that must be completed before the property can meet its income potential. Have the property inspected to ensure that there are no hidden issues or problems. Your financing details can come from your lender or mortgage broker, and the income details come directly from the seller, but don't rely on pro forma data. You can also talk to the property management company currently handling the property, if one exists. Your expenses should also come directly from the seller or property management company. A building inspector can warn you about any major upcoming repair costs, such as the need of a new roof or an HVAC system. Now this one is huge and very controversial. Pro forma versus actual data. Getting good data from your model requires reliable, accurate information. Remember, it's in the seller's best interest to provide appealing but not accurate numbers. For example, they may provide high rental property income estimates or neglect to mention certain maintenance expenses. This pro forma data from the seller merely kicks off the discussion. Before closing, determine the actual numbers. Ask to see previous year's tax returns, property tax bills, and maintenance records. Hopefully, the actual data is similar to the pro forma data, but it may be different. Part of the investor's job is to ensure that we have the best available information. And you'll want to check for potential surprises too. For example, when was the last time the property was assessed for taxes? It was a while ago and values have increased significantly. It's possible the property will soon be reassessed and your tax bill will increase. Even small changes to the income and expense numbers can mean big changes in your bottom line, as your disposition of the property will depend on the net operating income, which will be lower due to these increased expenses. In some deals I personally have looked into, I have seen some crazy information from the seller or their broker. For instance, I have seen some pro forma rents that are like 20 to 30% higher, with the explanation that the seller just wanted to be a nice landlord and have higher occupancy rates, so they kept the rents lower, but the market rents are actually higher. Now, if you are to purchase the property with the expectation that you'll increase the rents and everything will be okay, how many of the tenants do you think will actually stay if you raise the rents by 30%? And you can definitely expect those tenants to leave a mess and in need of repairs. Now let's go over comp analysis. Comp analysis is short for comparative market analysis, or CMA. Quite simply, it's a way to predict the value of a real estate asset by comparing it to the real estate values of similar assets recently sold in the area. Real estate agents like myself use various metrics to perform these analyses, typically the size, age, and location of a property, as these can be compared on a like-for-like basis. Rental comps are calculated the same way sales comps are, but instead of determining the potential sales price of the home, you will determine how much rental property income it can generate. Comp analysis can be performed by any building type, from a single-family home to a 100,000 square foot office building. Plenty of digital tools and services can give you the right data, including sales history, to perform comps on commercial real estate. One thing to remember is that unlike sales data that is recorded through public record, rental data is not usually recorded and usually kept somewhat secret by landlords and property management companies, so competitors don't catch on. The income analysis, or the income approach, is one of the most popular real estate valuation methods. It has a simple formula: net operating income divided by the capitalization rate, or your projected rate of return. I'll cover both elements of this equation in more detail later in the video. But first, let's find out how to work out our net operating income in real estate. Gross income is the total income generated from the property. When you collect monthly rents and other income from things like laundry facilities or parking fees, you generate income. For example, 1950 Maybury has 8 units renting for between $525 and $650 per month, for a total of $4,500 per month. In addition, there's $2,400 per year in additional laundry facility income. That means the total monthly income is $4,700, and the annual income is $54,000. Most of a property's income is generally derived from the monthly rents, making it extra important to account for unit vacancy. Most areas have an average vacancy rate, although your property's specific vacancy rate may be higher or lower. If so, you'll want to factor that into your analysis. You may need to actually lower the rents and increase your occupancy. Here are questions to ask if the vacancy rate doesn't correlate with the average local vacancy. Is the data pro forma or actual? And if it's actual, what is the current management doing to keep the building filled? And is the rent lower than market rent? And why? When do the current leases expire? You'll need to determine what you think is a reasonable vacancy rate going forward. I recommend being on the conservative side. Before you start to generate rental income on these real estate investments, get an idea of how much rental income you can expect to earn from your real estate investment. Start by subtracting the income that you likely won't see due to vacancy. In our example property, only 1 out of the 8 units are vacant, equating to a 12% vacancy. We'll use that number for our analysis. This means our total monthly income would be $4,160, with a total of annual income of $49,920. Now let's calculate our net operating income. One of the metrics of your financial analysis is your NOI, or net operating income. This determines the property's total income after all the expenses, not your loans. Unless there's a 12 months of data, your NOI is calculated monthly using income and expense data, which can be easily converted to annual data simply by multiplying it by 12. Let's cover analyzing the right expenses. In general, expenses break down like this. Repairs and maintenance are estimated based on the age and condition of the property. When estimating potential repair costs to budget for, look at the property itself. Generally, you can assume between 5 to 15% of the rents, depending on the condition and age of the property. And remember, you may go 6 months without a single repair and then get hit with a $1,500 water leak. Then you have your capital expenditures, also known as CapEx. This means those expensive big ticket items that need to be replaced every so often, such as your roof, appliances, and HVAC systems. For each major system, estimate the cost to repair divided by the remaining lifespan and set aside that amount each month. I always calculate just 10%, just to be on the safe side. Then there's management. If you employ a professional property manager, those companies typically charge a percentage of the rent and leasing fee to rent out a unit. These numbers can change based on your local data, but in my area, property managers charge about 10% of the rents. Then there's advertisement costs to find tenants or a buyer. There's landscaping costs, unless the tenants do their own. Utilities, assuming any portion of utilities are actually paid by the owner. Your insurance costs, and property taxes, even though these are usually reassessed when the property changes hands. Convert any monthly expenses to their annual cost to find the property's annual operating cost. Here in the illustration, you'll show that all the expenses add up to $12,751. Now that we know your total annual income and expenses, we can calculate your NOI. $49,920 minus $12,751 is $37,169 per year. But the NOI doesn't give you the whole picture or enough information to make any decisions. Instead, it is the basis for calculating most of the important metrics in our analysis. But before we dive into those, I ask that you hit the like and subscribe buttons down below, as it lets us know how we can put out more content specifically tailored for you. Now let's cover the common real estate performance measurements in a real estate analysis. We've learned that the NOI is the property's total income, but you might wonder, why doesn't NOI include the expensive cost of the loan, since that will ultimately affect your bottom line? Now, there's a few things that go into that, so let's go over them. Number 1, cash flow. Cash flow is the money left over after all the bills have been paid, including the mortgage. But not everyone knows your income may include more than just the rents. Depending on the type of property, you may charge tenants or guests like a cleaning fee, parking fee for more than a certain number of vehicles, or even a fee for a limited number of garages in a complex. And remember, the higher your loan payments, the smaller your cash flow. If you pay cash for a property, your cash flow is the NOI exactly, because that's the property's maximum cash flow. The monthly debt service on Mayberry is $2,129, making the annual debt service $25,548. For this property, the cash flow would be $37,169 minus $25,548 equals $11,621 of cash left over. Let's go over the rate of return. Cash flow isn't the only important factor. You must consider the rate of return, also known as your ROI, or return on investment. Your ROI is your cash flow relative to the cost of your investment, or what's known as your basis. So mathematically, that would be your ROI equals your cash flow divided by the investment basis. But what is a reasonable ROI? Let's compare other investing vehicles. High interest savings accounts often have an ROI, or an interest rate, of between 1 and 5%. A CD, or certificate of deposit, right now sports an ROI of about 5%. The stock market has an average ROI of 8 and 10%, and real estate investment trusts, or REITs, right now are sporting an ROI of 11.8% on average. You have to decide if this is truly the right investment vehicle you want to pursue. Number 3, capitalization rate, or cap rate. Just like NOI is completely independent of financing costs, cap rate is a neutral figure independent of the buyer or their financing. It's calculated as follows. Cap rate equals NOI divided by the property's purchase price. Cap rate may be the single most important number in your real estate investment analysis. The cap rate, or capitalization rate, is independent of the buyer and their financing, making this calculation the purest indicator of a property's potential return. So here's the cap rate for our Mayberry property. $37,169 divided by the purchase price of $418,000 is 8.89%. Not bad. You also need to understand that cap rates are market specific. A good investor-friendly agent will follow cap rates in a market, but be aware the cap rate for a strip mall won't be the same as a large multifamily complex, as the needs are quite different. A city's need for housing is different from its need for a 6th beauty salon or coffee shop. Number 4, cash on cash return. Just like there are multiple income measurements, NOI, and cash flow, there are also multiple measurements of return. The cap rate is the rate of return independent of financing, and the cash on cash return is dependent on financing. It's directly related to the amount of cash you put down. If you put $100 into a savings account, you might receive $4 per year, or a 4% ROI. The cash on cash measures your return if you put that $100 into property instead. Cash on cash is calculated like this. Your cash on cash return is equal to the cash flow divided by your investment basis, or the money you put in. For Mayberry, the annual cash flow is $11,621. In total, the down payment, improvements on the one vacant unit, and closing costs equals $98,000, creating a cash on cash return of 11.86% in the first year. Important, historically, your cash on cash return will increase every year as the rents increase. Number 5, your total return on investment, or TROI. In addition to cash flow, there are several other key financial considerations in your real estate investment analysis. One of those being your tax consequences. You may gain or lose money to taxes. Property appreciation. The real estate market is volatile, so you may not be able to predict this. As mortgage rates climbed quickly in 2023 and 2024 here in Des Moines, Iowa, there were a few months that showed no appreciation at all. Then there's your equity accrued. This is the difference between the value of the investment and the amount remaining on the mortgage. Remember, your tenant's rent covers the mortgage payments, or at least it should. Cash on cash only considers cash flow's financial impact. Total ROI, or TROI, considers all the factors affecting your bottom line. It's calculated as follows, where total return contains all the considerations above. TROI equals total return divided by your investment basis. So let's assume we can expect a 2% yearly appreciation for Mayberry, or $8,360. The equity accrued in the first year of the mortgage is $3,251. And for this example, no tax breaks are available. The total return for Mayberry would be $23,232, making the final ROI 23.71%. Real estate investment analysis involves a series of number crunching exercises that can help you predict your ROIs with a high degree of accuracy. Rather than relying on a single metric like cash flow or cash on cash, an investment analysis takes advantage of all metrics available to an investor to predict the return. As mentioned, no investment analysis can be 100% accurate. However, perseverance over time will pay off when you invest in real estate. No, you can't predict the future, but you should extend your analysis out a couple of years using trends or demographic data indicating the direction of the market and inflation. The more data you collect consistently, the better your projections will be. The better analyses you are able to make, and the better you will become at choosing investment properties that deliver returns worthy of your money and effort. Make sure to subscribe to the channel, because in the next video, we go over whether you should invest for cash flow or equity. And if you're looking to invest here in the Des Moines, Iowa area, I am an agent here and can help find properties that fit your specific investment strategy. I'll leave my contact info down below. I look forward to hearing from you.